Imagine waking up and seeing the silver price on your screen crashing by 40% in a single week. The news headlines are screaming that the bull run is over, the bubble has burst, and that silver is heading back to the basement. But while the Western world is panicking and dumping their paper contracts, something very strange and very powerful is happening across the ocean. In the bustling markets of Shanghai and the jewelry hubs of Shenzhen, the reality is the exact opposite. People aren't selling. They are desperately trying to buy, and they are willing to pay a massive premium, nearly $12 per ounce over the international price, just to get their hands on a single physical bar. Welcome to the great silver decoupling of 2026. This isn't just a market correction. It is a fundamental shift in how the world values real, physical assets versus digital promises. Today at Let Finance, we are diving deep into why the Shanghai silver premium has exploded again, what it tells us about the hidden shortage in the global supply chain, and why the next few months could be the most volatile period for silver in human history. If you think silver is just a cheaper version of gold, you are missing the most important story in the financial world right now. To understand why silver is acting so crazy, we have to go back to what traders are calling the war shock. In late January 2026, the silver market was on fire, hitting a staggering all-time high of $121 per ounce. Investors were betting that the Federal Reserve would be forced to cut interest rates to save a struggling economy. But then the White House dropped a bombshell. They nominated Kevin Warsh to be the next chair of the Federal Reserve. Warsh isn't your typical central banker. He is known as a monetary hawk, someone who believes in sound money and tight discipline. Almost overnight, the easy money narrative died. Markets realized that under Warsh, interest rates would likely stay high for a long time. The US dollar surged, and silver, which doesn't pay interest, suddenly looked less attractive to big institutional players in New York and London. This triggered a massive sell-off in paper silver contracts. On January 30th alone, silver futures plunged nearly 39% in what was the biggest one-day wipeout in the metals history. Billions of dollars in paper wealth evaporated in hours. But here is where the story gets interesting. While the paper markets on the COMEX in New York and the LBMA in London were in a free fall, the physical silver market in China was sending a completely different signal. On the Shanghai Gold Exchange, which deals mostly in physical delivery, the price didn't fall nearly as far. Instead, a massive gap opened up between the West and the East. This gap, known as the Shanghai Premium, spiked to over 13%, or roughly $11.80 per ounce above the international benchmark. Think about that for a second. If you were a trader in London, you could see silver quoted at $70, but if you actually wanted to buy a bar in Shanghai, you had to pay over $81. This premium is a huge red flag because it tells us that real, physical silver is incredibly scarce in the place where it is needed most. China isn't just buying silver for fun. They are the world's workshop, and their industrial hunger for this metal has reached a breaking point. The primary engine behind this massive Chinese demand is the solar energy industry. China currently controls over 80% of the world's solar panel production. Here is the kicker. The Chinese government set a massive policy deadline for April 1st, 2026. On that day, they scheduled the complete removal of export tax rebates for solar products. This move effectively raises the cost for solar manufacturers by 9% overnight. To avoid this, manufacturers have been in a frantic race to finish their production and ship their panels before the deadline. This front-loading behavior created a massive artificial spike in silver demand in the first quarter of the year. Manufacturers needed silver paste for their solar cells, and they needed it immediately. This industrial rush is part of why China imported a record-breaking 790 tons of silver in just the first 2 months of 2026. Before we go any further into the geopolitical chaos and the retail frenzy that is driving this market, I want to take a quick second to welcome all of you to Let Finance. We spend hundreds of hours researching these deep dive reports so you can stay ahead of the curve. If you find this analysis helpful, please hit that like button and subscribe to the channel. It really helps the algorithm show this video to more people who need to understand what is happening with their money. Also, make sure to turn on notifications so you don't miss our upcoming report on the gold market's hidden movements. Your support allows us to keep bringing you this level of research-backed content without the mainstream media bias. Now let's get back to the strange events in the Middle East that just threw a wrench into the silver market. While silver was already dealing with policy changes in China, a war broke out in the Middle East that had a very unexpected impact. In late February and early March 2026, conflict between Iran and the US-Israel alliance escalated, leading to missile strikes on Qatar's Ras Laffan industrial city. Ras Laffan is the heart of the world's LNG supply, and when it went offline, it didn't just hurt the energy market. It created a massive shortage of helium, which is a byproduct of natural gas processing. Why does helium matter for silver? Because helium is essential for cooling the equipment used to make advanced semiconductors and AI chips. When the helium supply was cut by 30%, chip factories had to slow down. Since silver is a key component in AI servers and data centers used for its incredible conductivity, the sudden slowdown in chip production actually caused a temporary panic about silver's industrial future. Investors were worried that if the chip world slowed down, silver demand would fall. This demand destruction fear added more downward pressure on the paper price in the West, even while physical silver remained scarce. However, the reality on the ground in China's retail sector tells a different story. In the Xubei jewelry market in Shenzhen, which is the heart of China's precious metals trade, a full-blown retail frenzy has taken hold. With gold prices hovering around an incredible $5,000 per ounce, ordinary people are looking for a cheaper alternative to protect their savings. They have turned to silver. Merchants in Xubei report that their silver inventories have been completely drained. One trader mentioned getting calls in the middle of the night from people desperate to reserve silver bars. Some merchants even tripled their inventories, and yet the shelves are still empty. This isn't just about big factories. It's about millions of individual savers who no longer trust the paper currency system and want to hold real physical metal in their hands. This brings us to a critical point: the massive divide between paper silver and physical silver in the Western financial system. Most people trade silver through ETFs like the iShares Silver Trust, or SLV, but in March 2026, the SEC implemented a new regulation requiring these ETFs to have 100% allocated physical backing certification. This created a liquidity crisis. Investors realized that if everyone asked for their physical silver at once, the vaults in London and New York might not actually have enough to go around. This led to a decoupling where the SLV trusts started trading at a significant discount to the actual value of silver. Essentially, the market was saying, we trust the metal, but we don't trust the paper promise. This lack of trust is exactly why the Shanghai premium is so high in China. When you buy silver, you usually take delivery of the physical bars. The structural foundation for this entire crisis is a massive supply deficit that has been building for years. The year 2026 marks the 6th consecutive year that the world has used more silver than it has mined. The Silver Institute projects a shortfall of 67 million ounces this year alone since 2021. The cumulative deficit has grown to over 800 million ounces. That is nearly an entire year's worth of global mining production that has just disappeared from the world's stockpiles. Silver is unique because it is mostly mined as a byproduct of other metals like copper, lead, and zinc. This means that even if the silver price goes up, miners can't just flip a switch and produce more silver. They have to mine more of the other metals first. This makes the silver supply incredibly inelastic. We are essentially eating into our historic stockpiles to fuel our modern world. Every solar panel, every electric vehicle, and every AI server is a one-way trip for silver. Unlike gold, which is almost always recycled, the silver used in industrial applications is often used in such small amounts per device that it is too expensive to recover. It is essentially consumed. An electric vehicle uses about 25 to 50 grams of silver, nearly double what a traditional car uses. By 2027, EVs are expected to overtake internal combustion engines as the primary source of automotive silver demand. When you combine this with the massive expansion of data centers for AI, you have a recipe for a permanent supply squeeze. The Silver Institute notes that AI server clusters can use up to 3 times more silver than traditional servers. We are building a high-tech future on a metal that we are running out of. So, what does this all mean for you? The high Shanghai premium is a canary in the coal mine. It is telling us that the paper prices in the West are being suppressed by financial manipulation and high interest rates, while the physical reality in the East is one of extreme scarcity. History shows that when these gaps get too wide, they eventually resolve themselves with a violent move in price. Either the Shanghai price has to come down or the Western price has to surge to catch up. Given the massive industrial demand and the 6-year supply deficit, the most likely outcome is a short squeeze where paper traders are forced to buy physical metal at any price to cover their positions. We are already seeing exchange inventories in New York and London drop to multi-year lows. The physical floor for silver is much higher than the paper ceiling that the banks have tried to maintain. As we move deeper into 2026, the volatility is not going away. Silver is currently trading in a range that the experts call compressed. Options markets are pricing in massive daily swings, suggesting that the market is waiting for a spark to ignite the next big move, whether that spark is a ceasefire in the Middle East, a pivot from the Federal Reserve, or a realization that the Chinese stockpiles are finally full. The result will be the same: a massive repricing of silver to reflect its true value as a strategic industrial resource. The days of silver being treated as a boring precious metal are over. It is now the most critical functional metal for the green energy transition and the digital revolution. We want to hear from you. Do you think the Shanghai premium is the signal of a coming explosion in silver prices, or is it just a temporary glitch caused by Chinese tax laws? Are you holding physical silver, or do you prefer the liquidity of paper markets? Let us know your thoughts in the comments below. We read every single one, and your insights help the whole Let Finance community grow. If you found this deep dive valuable, please share this video with one person who cares about their financial future. Understanding these global shifts is the only way to protect your wealth in this new multipolar economy. Thanks for watching, and we will see you in the next one.